speaking with Reece Birtles, Chief Investment Officer, Martin Currie, Australia, part of the Franklin Templeton Group, but Martin Currie is soon to be rebranded ClearBridge. Reece, first of all, it's a great pleasure to have you participating in the Inside Network's Equities and Growth Symposium.
Thanks, James. Yeah, so we're rebranding to ClearBridge, which for us is a bit of returning home because we were JP Morgan Investment Management in Australia in the 90s and we were sold to Solomon Smith Barney, which is today ClearBridge. So we know all the guys and looking forward to it.
Now, Reece, let's cut to the chase. Markets very, very turbulent at the time we're speaking. Big drawdowns in the indices, and as a value manager, this must be the time that your team really lives for. This is the time to do some good.
Yep, I mean it's sort of amazing. We're long-term investors. We're really looking at the fundamentals and what a stock's worth over its discounted cash flow life of 20 years. But we're always assessing the current price against that long-term value. And when you get volatile markets, that's when the opportunities and the distortions in pricing compared to fair value really open up. And not all stocks behave the same in that time. So we tend to find that our turnover in our portfolios might be 20% in most years. And then you get these sort of distortions. We might do 60% turnover in a year. And it's that turnover that really creates excess value for in terms of alpha.
An amazing amount of froth can come out of markets really quickly, can't it?
It can. I mean, we look at the Australian market and, we did think it was overvalued coming into this period, but nothing like the US. We'd say that the Australian market was probably 15% overvalued, but, you're probably talking about the US being more like 40% overvalued. So, we think even though the Australian market's come down, with the US at this stage, we think they'll start to disconnect because the Australian domestic fundamentals, potentially get better on the back of cheaper imports from China.
Now, as a value manager or a valuation-focused active manager, what makes such a fund true to label? What are the defining characteristics of such a style?
Yeah, I mean, we're a value manager, but we don't hate growth and we don't hate quality. We love both. What we really do is, value that growth or the quality characteristics of a company. And so we're looking for stocks that are trading at a discount to an unbiased valuation of future cash flows. And so it's that discipline in the process of focusing on how undervalued a stock is. And we also think, we're a bit different in terms of we won't take risk all the time. When there's a lack of opportunities in the market, we'll take less risk, active risk compared to times when you get dislocations like today when, it's really worth buying into differentiated contrarian positions.
How do you balance quantitative signals with qualitative judgment when you're running your eye over the book or the potential, the short list constantly and looking to identify undervalued or overvalued positions?
So we think, all our true alpha, all our real insights come from fundamental analytical judgment. So it's people understanding how a business evolves in the future and what its earnings are going to do. But we're a bit different to some fundamental managers where we're quite numeric. So we really look to forecast earnings. We have a very disciplined valuation approach, a very disciplined investment approach where we're balancing value, quality and momentum characteristics on each stock. And it's sticking to that process and looking for that distortion between our assessed value and market. So that's quite numeric in many ways and quantitative, but all the insights and the differentiated views really come from the qualitative component. But it allows us to really measure market opportunity and see what's there today.
It's a concentrated portfolio, so how within that do you manage risk across sectors and individual positions while maintaining conviction?
Yeah, so we're always looking for the degree of opportunity, which we define as the degree of undervaluation compared to the risk. And so we're looking at how volatile we expect the stock to be in terms of its quality, in terms of its debt, in terms of the size of the company. So for two companies with equal opportunity, the riskier one we'll take a smaller position in compared to the higher quality one because we don't want any one stock to dominate portfolio performance. We want good diversification across the 30 active positions that we have. And then we are always looking at the degree of opportunity. So if there is excess opportunity in energy, for example, we'll own more than one company. But if it's only an average opportunity, we might be neutral the energy sector and long one name and short the other.
What role does ESG play in your investment process, and how has it, if it has, influenced your recent decision making? How has it done so?
So we're what you call an integrated ESG manager. So in assessing the quality and the cash flow potential of the company, we'll take ESG issues into account in terms of, we look for the most important sustainability risks for the company. We have a clear assessment of the governance of the company and how well it's aligned with shareholders and licensed to operate. But we're doing that we want a bigger return for riskier companies, and we also want to engage with companies to get them to improve. Really, probably a good example in recent years has been Medibank, with that cyber attack. And, our assessment was that they were a good company. They were unlucky in terms of the cyber attack. That wasn't because they were bad, and that they had a good relationship with their customers and they had a good purpose. And we really believed that they could work through that process. So for us, the ESG event was a buying opportunity at a discounted price. And I think, the company's really executed since that time to demonstrate the benefit of knowing this is a good ESG company compared to other ones that are not really looking after their customers.
Reece, as markets evolve, how do you see the relevance of value investing changing, if at all, and where do you see the greatest opportunities ahead?
Yeah, so we would argue that in some of the big macro factors in the last 20 years have made it difficult for value investors. So we've been in an environment where the bond equity return correlation has been negative. That's very unusual. Prior to 2000, it didn't exist that way. And we've also been in a situation where bond yields have been less than nominal GDP, effectively a free money environment. In that, those two factors have made it quite hard for active managers in general, but especially for valuation. The valuation premium really hasn't been delivering excess returns. So we think, we've seen in the last 2 years that equity bond correlation's returned to positive. Trade wars and the like is likely to make bond yields higher compared to nominal GDP. And so that now money costs something. So people are going to differentiate between good and bad in terms of valuation. So we think that's important. But most importantly, regardless of whether those causes are correct, we measure how big the spread is between how cheap the portfolio is compared to the market. And on average, it's about 20 to 25% cheaper than the market. But today, it's like 40%. It's similar to tech bubble, 40%. It's similar to GFC. It's similar to COVID. This is one of the biggest distortions between the cheap stocks in the market and the rest. But what's different today is those names are low beta, high quality names. Whereas in GFC, in COVID, you're in a crisis. The cheap names were risky. Whereas in a tech bubble today, the cheap names are actually the high quality companies. So we expect, just like in the 2000s, value investing, excess return premium for lower risk, the perfect combination. Whereas people have not seen that for over 15 years.
Reece Birtles, Chief Investment Officer at Martin Currie, soon to be rebranded as ClearBridge. Thanks very much for your time here today at the Inside Network Equities and Growth Symposium.
Thanks, James.